Hello and welcome to Course 4 of the Oregon Verifier Training. My name is Stephanie Summers and I am the Greenhouse Gas Reporting Program Reporting Specialist responsible for fuel supplier reporting. This course covers verification of liquid fuel suppliers. For any questions related to this training program, please contact us at 3pverify@deq.oregon.gov. As a short disclaimer, the information presented in these slides does not replace your responsibility to know and abide by DEQ's third-party verification regulations or the requirements of our greenhouse gas reporting program. Please read the regulations, and if any information conflicts, the regulation takes precedence. There are some additional handouts we have created for you as reference materials, which you can find on the Verification Training webpage. They will be helpful as we go through the training and for afterward when you are reviewing the information. We're going to start today's training by talking about Oregon's fuel distribution system. We'll then discuss which fuels are required to be reported, who is required to report them, and what the requirements for reporting are for the program. After that, we will talk through the verification process for liquid fuels and end today discussing a few reporting examples. DEQ's Greenhouse Gas Reporting Program began collecting data in 2010 and collects data from natural gas suppliers, fuel suppliers, stationary sources, and electricity suppliers. This information is then used to create the sector-based greenhouse gas inventory for Oregon and to inform policy decisions. The transportation sector is the largest contributor to greenhouse gas emissions in Oregon, making up approximately 36% of total greenhouse gas emissions in 2021. The goal of the Greenhouse Gas Reporting Program is to collect the data for an inventory of emissions within boundaries of the state of Oregon. We collect data on all fuel being distributed in state. This ensures as robust of an inventory as possible. Next, we're going to be talking about the distribution of liquid fuels in Oregon. Much of the gasoline and diesel imported into Oregon comes from refineries in Washington. A small amount comes from other refineries in states to the east of Oregon or from Alberta, particularly for suppliers in eastern Oregon. This is true. Portland has the bulk terminal capacity in the state, but there is also a pipeline from Portland down to Eugene, Oregon, where there is a smaller terminal. Barges carry fuel to Portland and upstream on the Columbia River to Umatilla, Oregon, or Pasco, Washington. These barges often also transport ethanol from the Alto Columbia ethanol facility in Boardman, Oregon, when they return to Portland. This slide provides a list of regulatory provisions for the Greenhouse Gas Reporting Program and third-party verification relevant to fuel suppliers. We will touch on the key rules during this training, but you should review the full applicable regulations prior to the exam. All our greenhouse gas reporting rules are found in Division 215 of Chapter 340 in the Oregon Administrative Rules. You will find general reporting requirements in Rules 10 through 60 and specific requirements for fuel suppliers in Rule 110. Third-party verification rules are found in Division 272. Rules from the Clean Fuels Program may be relevant for the greenhouse gas reporting of many companies, and I will discuss how that program is linked later in this training. The Clean Fuels Program regulations are found in Division 253. Next, we're going to discuss which fuels are regulated by the Oregon Greenhouse Gas Reporting Program. All fuel types defined in 40 CFR Part 98, Subpart MM, must be reported to the Greenhouse Gas Reporting Program. There are no exemptions for different uses for the fuel. All fuel combusted or oxidized in Oregon should be reported to the program. Here is a list of the most common fuel types that are reported to our program. The list on this slide is not exhaustive. Please use the handout provided of all fuels that Greenhouse Gas Reporting Program has in the OFRS system to ensure that entities are reporting everything they are bringing into the state of Oregon. Fuels can be reported as gasoline formulation unknown and diesel formulation unknown. Components are reported separately in the Greenhouse Gas Reporting Program. For example, biodiesel and ethanol must be reported individually. Fuel cannot be reported as B5 or E10. Verifiers must review reporting from year to year to ensure that there are not fuels that are being reported in some years and not in others, or to get an explanation of why that is happening in the entity's reporting so it can be noted in the verification report. It may also be useful to use the handout that was provided for this training to run through all of the fuels that entities must report in order to determine if you are getting the full scope of their reporting. Gasoline sold in Oregon is mostly conventional blend stock, also known as CBOB. C-B-O-B. Reformulated gasoline is not required in Oregon, but it is common to see small amounts reported each year due to our proximity to California. E10 is required by the state renewable fuel standard. E15 blends are also allowed to be distributed statewide in Oregon since January 2022. For diesel, Oregon mostly has distillate number 2 reported, though we do get other types of diesel reported. It is important to note that reporting must include all diesel, whether it is dyed or not. We do not have exemptions for dyed diesel reporting. A B5 blend is required by the state renewable fuel standard, but blend rates are also increasing because of the Clean Fuels program. Some diesel is dyed, which marks it as a non-road fuel. This is done for fuel tax purposes, and dyed fuels are not excluded from greenhouse gas reporting. Most biofuels are currently imported, though Oregon has an active ethanol producer. Biodiesel can be sold as pure blend stock, which is considered such when there is over 90% of the biodiesel in the blend. Diesel is required to be blended in with the biodiesel, and that small amount of biodiesel must be reported. If the exact percentage is not known, it can be split at 99% biodiesel and 1% biodiesel when reported. Renewable diesel is also increasingly common and should be verified as with other biomass-based fuel types. A variety of liquefied petroleum gases fall under the Greenhouse Gas Reporting Program regulations, but often commercial propane is reported. Any LPG mixture that is at least 90% propane can be reported as propane, but lower mixes should be reported as their constituent parts or using the general LPG fuel type. Aviation fuels are also covered under the reporting rule. Kerosene type jet fuel that is used for most commercial turbine engines makes up the bulk of this fuel. However, there is also a lot of aviation gasoline reported. Kerosene can also be reported as a separate component for mixture into kerosene type jet fuel or other uses in the state. Next, let's dive into the reporting requirement for fuel suppliers. Reported data to the program is used for the greenhouse gas emissions inventory. Our program's goal is to capture all fuels being combusted or oxidized in the state of Oregon. This reporting requirement applies to all fossil and biomass-derived fuel types and to any dealer or seller subject to the Oregon Motor Vehicle and Aircraft Fuel Dealer License Tax under OAR 735.170, any seller subject to the Oregon Used Fuel Tax under OAR 735.176, and any person who produces, imports, sells, or distributes at least 5,500 gallons of gasoline, distillate fuel oil, biofuels, aircraft fuel, or 10,500 gallons of propane in a year. Fuel being brought into the state for any type of use should be reported to the Greenhouse Gas Reporting Program. The use does not need to be tied to transportation. A key responsibility of the verifier is to ensure that the company accurately reported all required fuel types, which includes all end uses. For example, fuel provided for heating must also be reported under the Greenhouse Gas Reporting Program. Now, for a closer look at which entities are required to report to the program. Instead of requiring every company that meets the applicability threshold to report to the Greenhouse Gas Reporting Program, we require reporting from two specific types of fuel suppliers bringing fuel into the system. The first is the position holders. A position holder is defined as any company that owns fuel in and disperses fuel from a terminal to entities that pick it up below the rack. Fuel that is held outside of the terminal is not included in this fuel supplier category. Records of the terminal operator must show that the entity holds fuel or position in the terminal for the entity to report as the position holder. If an entity is the last entity to own fuel before it is dispersed at the rack, they report that fuel in the position holder fuel supplier category. For the purposes of the Oregon Greenhouse Gas Reporting Program, a terminal is a fuel storage and distribution facility supplied by pipeline or vessel, or a facility co-located where the fuel is produced and stored, and from which fuel may be removed at a rack. It is important to note and remember that in-state fuel production facilities that have distribution equipment that allow them to distribute directly to retail sites or end users meet the definition of a terminal. This is the list of fuel terminals operating in Oregon, as determined by the Oregon Department of Transportation. In-state producers are not included on this list. Please note that the airport terminal is included here. If entities are position holders of fuel at that terminal, they must report those fuel volumes as they would for any other position holder transaction. In-state fuel production facilities that have distribution equipment that allow them to distribute directly to retail sites or end users meet the definition of a terminal and report as position holders. In-state producers are not required to report fuel that they produce and then directly export. If an in-state producer's fuel is brought to a terminal after it is produced and sold to other entities, it should be reported as position holder volumes by whichever entity last owns the fuel as it is sold to below the rack. The second fuel supplier category the Greenhouse Gas Reporting Program uses is the fuel importer category. This is an entity that imports fuel from outside Oregon and delivers it outside the bulk system, for example, not to a terminal. Most often, this applies to fuels being imported by truck. Some companies will need to report as both a position holder and a fuel importer if they import fuels both within and outside of the bulk system. Note that if fuel is imported outside of the bulk system, such as by truck, and subsequently brought to a terminal, it should not be reported under a fuel importer because it will be reported as a position holder sale when it is sold from the terminal. Next, let's dive into the reporting requirement for fuel suppliers. Position holder and imported volumes are reported separately under the fuel supplier categories discussed previously. Fuel suppliers are required to report the quantity of each fuel type they have supplied during the reporting year. Blended fuels such as E10 must be reported as their individual constituents. Volumes must be reported as temperature-corrected gallons unless the entity has received an exemption to report using gross volumes. This often occurs if fuel is being sold from an intermediate storage facility that does not keep records of the temperature of the fuel as it is sold. Entities must not report fuel that was imported and then later exported from the state of Oregon. It's important to ensure that the entity is reporting all fuel types required to be reported to the GHG reporting program. There are many fuels that the Greenhouse Gas Reporting Program requires to be reported, whereas CFP does not require reporting of all those fuel types. The Oregon Fuels Reporting System calculates the emissions using reported volumes of fuel and fuel types and the quantification methodologies in Title 40, Part 98 of the Code of Federal Regulations, Subpart C and Subpart MM. Although the regulations require fuel suppliers to report emissions, these are calculated automatically within the reporting tool based on fuel type and amount. Let's take a quick look at those equations so you know how the emissions are being calculated. CO2 emissions for each fuel type are calculated using equation MM-1, as shown here. CO2 from biomass-derived fuels is considered a biogenic emission and is shown as biogenic CO2 in the annual report. Methane and nitrous oxide emissions are similarly calculated using the methodologies detailed in 40 CFR Part 98, Subpart C. Handout 2 for this training includes an emission factor for each fuel type that will calculate the emissions in metric tons of CO2 equivalents. The metric tons of CO2 equivalents includes the emissions of all three pollutants, with methane and nitrous oxide modified to CO2 equivalents using their respective global warming potentials. The Oregon DEQ Greenhouse Gas Reporting Program uses the Intergovernmental Panel on Climate Change's Fourth Assessment Report's Global Warming Potentials, commonly referred to as AR4 GWPs, to provide the total emissions in metric tons of CO2 equivalents. While the EPA recently updated 40 CFR 98 to include AR5, Oregon has not yet adopted these changes. The reporting system breaks out the emissions by biogenic emissions, which are emissions from biomass fuels, and anthropogenic emissions. Reporting being done by entities that only report to the Greenhouse Gas Reporting Program and not to the Clean Fuels Program are entered as seen in this slide. There is a section to add new records where the user can choose the supplier category and fuel type. Then they can enter the fuel amount in gallons. Once the user clicks on Save Record, OFRS will use the fuel type and the emission factors for that fuel type to calculate the emissions from that fuel and will display the emissions on the screen. Once the user reviews the information, they can add more fuel to their reporting, save what they have put in to come back to later, and complete the reporting, or submit the reporting if they are done. Next, let's discuss record-keeping requirements. Records supporting the reporting must be kept for 5 years if an entity is not subject to third-party verification. For entities that do have to get their reporting verified by a third party, they must keep the records for 7 years. Records should be kept of all product transfer documentation, or PDT. PDT can include bills of lading, or BOLs, invoices, and other records that document what fuels the entity must report. Record keeping for exports language has been updated in recent rulemakings and will be discussed in length in the next section of this presentation. The deadline for fuel suppliers to submit their annual greenhouse gas emissions reports to DEQ is April 30th. After submittal of the reporting through OFRS, verification activities can begin, and verification statements must be submitted to DEQ by August 31st. If these due dates fall on a weekend or holiday, the date will shift to the next business day. Now we will review how fuels reporting is linked between the Clean Fuels Program and the Greenhouse Gas Reporting Program, with a discussion of the transaction types and which apply to the Greenhouse Gas Reporting Program. We will also discuss exports in depth, as that has been a recurring issue for our reporting entities. Some of you may have been wondering why you were required to take the Clean Fuels Program verification training as a prerequisite for the Greenhouse Gas Reporting Program verification training. The reason for this is because reporting for both programs is often closely linked, not just in terms of the data, but also in how it is reported to DEQ. Now, as we go over the links between programs, it is important to remember that these are distinct programs with separate and unique reporting requirements. The goal of the Greenhouse Gas Reporting Program is to accurately track greenhouse gas emissions from the fuels sector in Oregon. The goal of the Clean Fuels Program is to lower the carbon intensity of transportation fuels used within the state over time. Since many companies are required to report similar data to both programs, we have combined the reporting system to make this easier for companies. However, entities must still submit independent reports to each program, and these must be independently verified. Companies might only report to the Greenhouse Gas Reporting Program if they are considered small, which would mean they import less than 500,000 gallons during the year, or only deal in fuels not required to be reported to the Clean Fuels Program, for example, aviation fuels. Other companies may be credit generators under the CFP, but do not supply any fuel types currently reported under the Greenhouse Gas Reporting Program, so they would only report to CFP. for example, electricity supplied to electric vehicle chargers. However, most liquid fuel suppliers report to both programs. Whether a company reports to both programs or only one, all reporting for fuel suppliers under both programs is done through the Oregon Fuels Reporting System, or OFRS. Hopefully, you are already familiar with the clean fuel side of this reporting. For entities that submit CFP quarterly reports, their relevant data is automatically aggregated for them by the system to create a base for their annual GHG report. The integrated design of reported data and the way the data flows from the CFP quarterly reports to the GHG reporting program annual report means it is essential that verifiers understand how the reporting regulations and the data flows of the programs interact and the important differences between them. This will ensure that when verifiers review data, they are able to ensure compliance with the regulations. So, how does that work? As we discussed, there are 2 points of regulation for fuel suppliers to report greenhouse gas emissions: position holders and fuel importers. These points of regulation are matched with 2 of the transaction types that fuel suppliers must use in their CFP quarterly reporting: position holder sales without obligation and imports outside of the bulk system. All fuel volumes that are reported under either of these transaction types are carried over to the Greenhouse Gas Reporting Program's annual report under the correct supplier type. Any blended fuels are broken out into their individual components. So if a company has used a B5 blended fuel pathway to report 1,000 gallons in a position holder sale without obligation transaction in a quarterly report, this will show up as 950 gallons of diesel and 50 gallons of biodiesel in the Greenhouse Gas Reporting Program's annual report. Since additional fuel types are covered under the Greenhouse Gas Reporting Program that are not regulated under the Clean Fuels Program, these additional fuels must be manually added to the report, which is done the same way a company not regulated under the Clean Fuels Program would add fuels. Fossil gasoline and diesel are aggregated as gasoline or diesel type unknown. Fuel suppliers can specify volumes of specific fuel types, such as conventional summer regular gasoline, out of this unknown type total. DEQ encourages companies to do this, as this gives us more accurate data and can also reduce calculated emissions. However, companies are not required by regulation to do so and are able to leave the aggregate fuel volumes as an unknown type. Please note, if an entity does not disaggregate the reporting by specific fuel type by the deadline for that reporting year, they cannot later disaggregate the data for that reporting year. The entity will have to wait until the next year's reporting to make these changes. The following slides will review various scenarios for fuels being imported, distributed, and exported in the state of Oregon. We will discuss how this is recorded in the Oregon Fuels Reporting System and which transactions populate the Greenhouse Gas Reporting Annual Report. We will also discuss some newly adopted rules and how they affect regulated entities and their tracking of exports from different areas. If you have a question during verification about a scenario you do not see explained here, the FAQ for our program is an excellent resource that explains many of the nuances of the programs and the reporting that must be done for them. At the most general consideration, greenhouse gas reporting is required for fuel volumes that are sold from terminals as a position holder sale or volumes that are imported outside of the bulk distribution system. This is quite simple. However, how the entity determines what to report under what transactions in the OFRS can be more complicated. So let's go through the different transactions in the system, what they are used for, and how they apply to the Greenhouse Gas Reporting Program. We will also discuss some potential situations that have caused issues for reporting entities in the past. The schematic above shows various points in the fuel distribution system in Oregon. Let's start with imports within the bulk system. This refers to fuel that is imported by pipeline or vessel and is delivered directly to a terminal. This is reported as an import within the bulk system in CFP quarterly reporting. This is not a Greenhouse Gas Reporting Program point of regulation and is not aggregated for the GHG RP annual report. This is because these fuel volumes are captured as position holder sales as the fuel is dispersed from the terminal. An example of this is fuel brought in by railcar that is then loaded onto a truck and delivered directly to a terminal for distribution. Reporting for this scenario in the CFP quarterly reporting may involve a few more transaction types, but as the fuel ends up in a terminal, one of those will be an import within the bulk system. Next, we have above the rack sales. These are transfers of ownership of fuel that occur within the terminals. These are reported as a sale or purchase with or without obligation in CFP quarterly reporting. This is also not a greenhouse gas reporting program point of regulation, and these fuel volumes are not moved to the annual GHG reporting program's reporting. An example of this would be if Company A holds 20,000 gallons of biodiesel in a terminal and then sells 10,000 of those gallons to Company B. They can choose to sell that fuel with or without obligation. The meaning of with or without obligation is that the credits or deficits that were generated when the fuel was imported can be moved from Company A to Company B, or Company A can keep the obligation and Company B has no obligation for those credits or deficits in the program. This detailed level of reporting is not required for entities reporting only to the Greenhouse Gas Reporting Program. Next up, fuel imports. First, let's consider a scenario where fuel has been imported by means other than pipeline or vessel, such as by truck, but is delivered within the bulk system. This would be reported as an import within the bulk system in the CFP quarterly reporting, and as discussed earlier, this is not a Greenhouse Gas Reporting Program point of regulation. These fuel volumes will not be moved to the Greenhouse Gas Reporting Program's annual report. A second scenario for fuel imports is one where fuel has been imported by some means other than pipeline or vessel and is not delivered to a terminal. This is reported as an import outside of the bulk system in CFP quarterly reporting. These volumes are often immediately distributed for use within the state, and any sales occurring after this point are considered outside the bulk system. These volumes don't have to be distributed immediately, though. They may be stored in intermediate storage of the regulated entity, who can then distribute those fuels later. This transaction is a point of regulation for the Greenhouse Gas Reporting Program, and these transaction volumes will carry over to the Greenhouse Gas Reporting Program's annual report under the category of fuel importer for the entity reporting the transaction. Unless reported otherwise as an export, these fuel volumes are considered as used within the state. If a regulated entity reports only to the Greenhouse Gas Reporting Program, they will record this under the fuel importer category in the Greenhouse Gas Reporting Program's annual report using the appropriate fuel type. One example of this would be fuel imported by truck that is delivered directly to a regulated entity's intermediate storage. Another is fuel delivered by truck from out of state to a retail site. Now on to position holder volumes. These are fuel volumes being sold out of a terminal across the rack to trucks picking up the fuel. If the fuel is staying in state for distribution, this is reported as a position holder sale without obligation in the CFP quarterly reporting. This transaction is a point of regulation for the Greenhouse Gas Reporting Program, and these volumes carry over to the Greenhouse Gas Annual Report under the position holder supplier category. For regulated entities that only report to the Greenhouse Gas Reporting Program, this would be reported as in the position holder category in the Greenhouse Gas Reporting Program's annual report. Next, we will discuss in-state production of fuel. If blend stocks are imported directly to a fuel producer for blending or other uses, or transferred from a terminal to a fuel producer or vice versa, these are considered transactions within the bulk system. This level of detail reporting is not necessary in the Greenhouse Gas Reporting Program's annual report, and these fuel volumes are not transferred to the Greenhouse Gas Reporting Program report. These volumes would later be reported as position holder sales from the terminal. Another scenario for in-state producers includes selling directly from their facilities for distribution to intermediate storage sites or retail sites. This is a rare occurrence, but does happen in Oregon. These sales can be reported using a combination of transaction types, but the position holder's sale for obligation transaction type is always one of the transactions used. These fuel volumes will be aggregated into the greenhouse gas annual report. If a production facility in the state of Oregon were distributing fuel from their production facility and not reporting to the Clean Fuels Program, they would need to report these fuel volumes under the position holder category in the Greenhouse Gas Reporting Program annual report by fuel type. However, if that were happening, that would be an issue to discuss with DEQ because the entity should be registered with the Clean Fuels Program. There are some specific situations for position holder sales that have caused incorrect reporting. Exempt fuel categories that are allowed under the CFP have caused confusion in the reporting for the Greenhouse Gas Reporting Program because regulated entities are uncertain if they should report both the position holder sale and the exempt fuel category for the fuel volumes, usually citing worries about double reporting. This is not double reporting. The position holder sales let us know that the fuel was distributed in state and should be moved to the Greenhouse Gas Reporting Program's annual report. The exempt fuels category is used by the CFP quarterly reports to show that those volumes are claimed as exempt and should not create deficits or credits for the entity. There are no exemptions for reporting a fuel used in state in the Greenhouse Gas Reporting Program's annual reporting. So, in the CFP quarterly reporting, any fuel claimed as exempt by a position holder that came from their position in a terminal would need to be reported as both a position holder sale without obligation and for the appropriate exempt use category. Fuels delivered to sovereign tribal lands within Oregon state borders also causes confusion in the reporting to DEQ because they are considered differently in the Greenhouse Gas Reporting Program and the Clean Fuels Program. For the Clean Fuels Program, fuels delivered to the sovereign tribal lands within Oregon are considered an export outside of the Oregon distribution system because CFP does not regulate fuels there. For the Greenhouse Gas Reporting Program, fuels delivered to the sovereign tribal lands within Oregon are within the state borders of Oregon and must be included in the greenhouse gas emissions inventory. For reporting to be correct in both the CFP and the Greenhouse Gas Reporting Program, the position holder sale without obligation must be reported for these volumes by the entity that is selling them from their position in a terminal. The entity that is delivering the fuel must report the export out of Oregon distribution system transaction, including a note in the transaction description stating that these volumes are going to sovereign tribal lands. Another special consideration for reporting in OFRS is when a position holder sells to a company that does not report to the Clean Fuels Program, and that fuel is then exported out of the state. In this instance, the position holder must report the export. The position holder sale for export and purchases below the rack for export are not required in this case. The position holder only needs to report the export out of Oregon distribution transaction type with a note in the transaction description as to who they sold the fuel to or that the company they sold to does not report to the Clean Fuels Program. The undefined business partner is used in this case. This is true even in the case of a diversion. The reason for this is that the Greenhouse Gas Reporting Program does not collect fuel volumes for exported fuels. The reporting by the position holder of only the export transaction simplifies reporting for that entity while keeping the volumes out of the Greenhouse Gas Reporting Program's annual report. We will discuss exports in detail even though they are not included in the Greenhouse Gas Reporting Program volumes that are required to be reported. New rules were implemented for the Greenhouse Gas Reporting Program in late 2023 that have affected reporting of these types of volumes. Fuel purchased for export will often be purchased at a terminal. In this case, the seller should report this using the position holder sale for export transaction type. These volumes will not roll up into the Greenhouse Gas Annual Report. For those entities who only report to the Greenhouse Gas Reporting Program annually and do not report to the Clean Fuels Program, and who also use the fuel importer supplier type, Exports should not be included in the fuel volumes reported in the Greenhouse Gas Reporting Program's annual report. However, for those entities that report to the Clean Fuels Program and the GHG Reporting Program, there is a case when exports need to be added to the annual report in the Greenhouse Gas Reporting Program. This is true when an entity reports fuel in the Clean Fuel Program's quarterly reporting as imported outside of the bulk system, and then those same volumes that were imported are later exported out of the state. In this case, the OFRS does not remove those gallons from the volumes that are moved over to the Greenhouse Gas Reporting Program's annual report, even if they are later reported as exported in the quarterly report. The volumes would erroneously still be included in the fuel importer category. In this case, the company must use the GHG exporter function available in OFRS. This adds an export category to the annual report in the Greenhouse Gas Reporting Program and is only done if DEQ is notified by the entity that they need to use this function. Please notify us if you fall under this category. For those entities exporting fuel out of the state, updates to the Greenhouse Gas Reporting Rules in 2023 included changes to what is necessary for documentation when exporting fuels. Documentation of those exports must include the following information: the amount of fuel delivered, the type of fuel delivered, the delivery date, and the state the fuel was delivered to. Product transfer documents, or PTD, are appropriate documentation for demonstrating export of fuel. PTD can include, but are not limited to, bills of lading, also called BOLs, invoices, and contracts. If a company is selling to another company that does not report to the Clean Fuels Program, the seller must keep information and proof showing the fuel was exported. If there is an issue with the documentation provided regarding exports of fuel, requirements were added to OAR 215 that detail what information the exporting party must provide to their business partners. This could occur if a reporting entity informs a position holder that they will deliver the fuel in-state when they're purchasing it, and later the fuel is instead exported out of the state. In these cases, the entity exporting the fuel must inform the position holder of the fuel type, amount of fuel exported, and state the fuel was delivered to 30 days prior to the annual reporting deadline for that year. 30 days prior to the annual report being due falls on or about March 31st. If the export was not recorded correctly in the CFP quarterly reporting originally, this will also require updates to the reporting for the quarter the fuel was exported. Once these corrections are known to the position holder, PTD should be updated to reflect what actually occurred with the fuel. If a company is selling to another company that does not report to the CFP, the seller must keep information and proof showing the fuel was exported. For those who have intermediate storage, the rule has updated language for how to report any of that fuel if it was exported when the fuel in the storage was purchased from more than one entity. Entities will need to determine the amount of fuel that was in the tank that quarter from each of the entities. Then use this information to determine the percentage of the fuel that was in the tank that belonged to each entity that quarter. Next, the entity would apply those percentages to the exported amount to determine how much of the exported fuel belonged to each entities. Entities must inform the position holders of the amount of fuel that was exported and how that was calculated in writing, so that the position holder can adjust their position holder sales for export and their position holder sales without obligation to account for these changes. If a request is made for this information from DEQ or the position holder, because the exporting entity is not given the correct information, the exporting entity must make that information available to the impacted position holder within 14 calendar days. As stated in the previous slide, this information should be made available to the position holder, and this 14-day request is used in cases where that has not occurred. Verifiers may also request this data to verify whether fuel was exported from or was distributed in the state of Oregon. I am not going to go through this slide, but I wanted to include it so that you have an example of how the amount attributable to each position holder should be calculated. Now we will discuss key elements of the verification process and a couple of examples of questions that could come up during verification. Third-party verification is required for any fuel supplier that reports anthropogenic emissions of at least 25,000 metric tons of CO2 equivalent. This threshold does not have any exempt fuel types or uses. However, biogenic emissions from applicable fuel types are not included for the threshold determination. The threshold is also applied collectively to all related entities who are fuel suppliers, so long as their combined emissions are above 25,000 metric tons of CO2 equivalents. So, if two companies are jointly owned and one has emissions of 20,000 metric tons of CO2 equivalents and the other has emissions of 10,000 metric tons of CO2 equivalents, then both companies will need to be verified. To verify the data that has been submitted to DEQ, check documents such as invoices, contracts, bills of lading, and financial transactions to confirm fuel types, volumes, and destinations. Ensure that metering equipment is properly calibrated and that volumes have been appropriately corrected for temperature. If they haven't been corrected for temperature, also called net gallons, determine if they have an exemption to report gross gallons. Also, check that the correct units have been used in reporting. Our program did use barrels previously, so you may see some reports that inadvertently still use this measurement. You will also need to verify that the data reported to DEQ covers all the activities and fuel types for the company during the reporting year, and that all transactions have been reported. Check how the company tracks this data. Is that system reliable? Can they replicate any queries they have used for you? Verifying this information is similar for all companies, but if your client also reports to the Clean Fuels program, you will also need to verify that they have correctly reported their transactions in the CFP reports so that this data is accurately aggregated for the greenhouse gas report. Are they using the correct dates for the transfer of fuel? Is one question that you could ask. I want to go through a few terms that are identified in the third-party verification rules that determine the result of the verification. Correctable errors are errors identified by the verification team that affect data in the submitted report and result from a non-conformance with program rules. A non-conformance is a failure to meet the applicable requirements of this division or the requirements of program rules to calculate reportable data. A material misstatement occurs if you believe the total error in emissions from discrepancies, omissions, or misreporting is greater than 5%. Correctable errors must be fixed if they are found for an entity to receive a positive or qualified positive verification statement. The 5% for a material misstatement is based on the total reportable emissions, not emissions from individual fuel types. When verifying information from companies, one issue we have seen since the program began is that verification is not always catching when entities are neglecting to report fuels to their greenhouse gas reporting program. This often happens because entities will see the data that is pulled over from the CFP quarterly reporting into their quarterly report and not realize that not all fuels will be pulled into the greenhouse gas reporting program's annual report. Only diesel, gasoline, ethanol, and biodiesel and renewable diesel are pulled automatically into the Greenhouse Gas Reporting Program's annual report. So, if a company is reporting propane to the CFP, that will not get pulled over into their annual report. They need to add that fuel separately when submitting their Greenhouse Gas Reporting Program annual report. Propane and LPG are examples of fuels not pulled over to the Greenhouse Gas Reporting Program annual report that may be reported to the CFP. It may also be the case that the entity does not realize all the fuels that need to be reported to the Greenhouse Gas Reporting Program. It would be useful to have a list of fuels required to be reported to the Greenhouse Gas Reporting Program and review them with the company to ensure they are not importing any other fuels into the state. There are several questions that should be asked during the site visit or communications with the company to determine if you are getting the full picture of the business being done by the company and that the data is being reported correctly to DEQ. These include, are you seeing where all the fuel transactions are kept by the company? Do they have more than one database to collect this data? If the folks reporting are the tax folks at the company, ensure they have talked to their coworkers that are handling the fuel flow at the company. The tax data may not give them all the information they need. Ask the entity to review the list of fuels required to be reported to make sure their queries aren't excluding a fuel type they should be reporting. Check multiple report years in the OFRS to ensure that the entity is reporting all fuel types consistently year to year. If they are not, the entity should be able to articulate why they are no longer reporting that fuel type. Entities often have employee turnover and new hires may not know this needs to be reported separately in the Greenhouse Gas Reporting Program's annual report. Issues with reporting aviation gasoline versus kerosene type jet fuel and propane versus LPG have been reported incorrectly to the program. Please review these fuels when verifying regulated entities and ensure that they match with definitions in 40 CFR 98 for what is being brought into Oregon. For our first example, imagine that a fuel supplier who is regulated under both the Clean Fuels and the Greenhouse Gas Reporting Program opens their greenhouse gas annual report and sees the data shown in the top right table, aggregated from their CFP reporting. They accept the data and submit it without any changes. While reviewing their records, you determine that they have supplied the fuels and volumes in the bottom left table. Have they made any errors in the reporting? If so, would it be a material misstatement or nonconformance? You can assume all the volumes in their data are correct. The submitted report was correct. Although we offer the ability to designate specific fuel types for aggregated gasoline and diesel volumes and encourage companies to make use of this, it is not a requirement. Companies may report gasoline and diesel types as unknown. The entity can be given a positive verification statement with this data. If you are verifying an entity's data and they want to designate specific fuel types, even though they did not do that originally, they are not allowed to go back and do that at this time. The company would be able to take advantage of specific fuel types with lower emissions factors in later years if they want to do that. For our second example, consider a company, Company A, who imports gasoline within the bulk system and holds it in their terminal. Company B purchases 1,000 gallons of this gasoline from Company A. Company B then immediately sells this fuel on to Company C, a jobber who is picking up the fuel at the rack for distribution within Oregon. Which of these three companies must report these gallons to the Greenhouse Gas Reporting Program as the position holder? Company A must report the position holder sale. Since the gallons are reported under the transaction type position holder sale without obligation, the gallons will appear in their GHG Reporting Program annual report from the CFP quarterly reporting. That brings us to the end of Course 4. If you have any questions, you can contact our team at the third-party verification email shown here. Thank you for watching.